to our March edition of AEM Achieve. All of you are currently in the listen-only mode. However, there is a window on your webinar screen where if you want to enter questions as we go through the presentation today, you'll be able to ask questions, or we'll try to get to all questions by the end of the session. I hope everybody's the first quarter of 2015 is off to a great start. It's great seeing that rates continue to stay low, and we're seeing a lot of housing prices continue to rise. A lot of people buying homes out there, so great news for the real estate and the mortgage industry. We're also seeing a lot of customers that are getting their credit resolved and able to qualify for homes now. One of the things that we've heard a lot from our realtor partners via the surveys that we've done is they'd like to hear more about credit repair and how they can help more of their customers qualify for financing and qualify to purchase a home. So we thought that at some stage we'd have an AEM Achieve event on credit repair and credit rescue, and that's what today's event is all about. For those of you that may be new to AEM Achieve, we developed this interactive session in order to find tools and deliver training that can help you build your business. We don't try to sell you anything in this process, and we want to be a resource to you to provide information that will help you gain more clients and grow your business. We're committed to one goal, get our customers and partners to a better place. Since most of what we do is working with realtors, we felt that this would be a great event to have for you as we get into the beginning of the year, especially as we get now into the selling season. So with that, we're going to go ahead and get right on, and I want to introduce today's guest speaker. We do a lot of work with Home Loans Assist. We're always speaking with clients that have credit challenges, and we have a follow-up program that allows us to stay in touch with those borrowers as they move through their credit repair, so that hopefully we can help them with a home purchase or a home refinance if they happen to already own a home. And Chris Heil and his team do a great job for us. Chris has been a top producing regional accounts manager for Home Loans Assist for 3 years. We've enjoyed a great relationship together. So Chris, first of all, I want to really thank you very much for attending today. He and his team have helped thousands of credit challenge borrowers become proud homeowners. Chris excels in public speaking and has a passion for educating realtors, clients, and our loan officers. Chris is originally from Nebraska. He's a Cornhusker. We won't hold that against him. He and his family now live in Aurora, Colorado, but Chris spends a lot of his time on the road, again, doing training sessions and helping educate lenders, realtors, and buyers. So without further ado, Chris, I'll turn it over to you.
Thank you very much, Mike. I greatly appreciate it. I'm not here to waste your time today, folks. I'm here to get right into things and show you exactly kind of where things are coming from and why things are as they are when it comes to credit scoring. First thing is know where you're at and know what's on your credit report. The easiest way to do that is go to annualcreditreport.com. It's the free website put on by the government, basically the Consumer Financial Protection Bureau. You want to know first and foremost what's on your credit report. You want to know it's 100% accurate, 100% complete, 100% verifiable. So if there's any issues, you can definitely address those with Experian or TransUnion or Equifax. They also have a lot of tips and tools to help people as well. Sometimes navigating that is a little difficult, but I'll get more into that here in a minute. The annual credit report does not give you scores, so the only way to get your mortgage scores is you'll definitely want to have your client speak with a lender right up front. First thing today, I want to address some of the myths and misconceptions about credit scoring models. Pay or not to pay is speaking towards collections. Oftentimes your borrower will see their credit report and say, oh, I need to fix that. I need to fix my score. I'm going to pay these collections off and my score is going to go up. The problem with that is that the algorithms that calculate the score cannot be wealth biased, meaning it doesn't matter if you have a $50,000 debt, a $10 debt, or a $0 debt. If it says collection on the credit report, it's going to be doing damage to the score. And actually, by paying an old collection, you can actually negatively impact your score. It will actually drop. The reason for this, again, is those algorithms can't be wealth biased. As a debt ages, it becomes less and less impactful on the score. When you pay an old debt, you're doing what's called refreshing the last date of activity, and it goes back to doing the most amount of damage it possibly can with that brand new date of last activity. So typically, I want to have somebody either pay the debt off when they first see that collection, or let's see about mitigating some of the damage by using a restrictive endorsement or a few other little tools that we have available for them. Now, the next most common question I get from people is this reporting an error or not? When we take a look at a credit report, we go through it line by line with our clients, and every time, same thing happens. They're like, hey, what is this debt? And I look at them and I'm like, it's your credit report. I don't know what that is unless you tell me what it is, or it says specifically on there. The problem is that a lot of times debts get sold between collection companies, and oftentimes they won't say who the original creditor is. Well, that's a blatant disregard for the Fair Credit Reporting Act, and it's not allowed to be there. So we're going to go through and take a look at all those surface errors first. Now, should this have fallen off already is another point that a lot of people think. They're like, well, 7 years, this debt's going to go away. Well, it's 7 years from the last date of activity. If you have a debt that, say, you were trying to make an effort to pay on last year, you actually created a new date of last activity, and they have 7 years from that date of the last activity. So now instead of having it gone, say, next year when it was supposed to fall off, they have a full 7 years after the date of activity to address that now. That's, again, how that can negatively impact your score by creating that new date of last activity. Now, do they have to report your car loan? Is it mandatory to report to the credit bureaus? This question comes out fairly often. The simple answer is no. Nothing has to be reported to the credit bureaus. Reporting to the credit bureaus is 100% voluntary. Collection companies oftentimes use this against people, saying, oh, the Fair Credit Reporting Act states everything must be 100% accurate, 100% verifiable, 100% complete, non-misleading, not obsolete. I have to report this item. That's 100% false. That is what the Fair Credit Reporting Act says, that everything must be 100% accurate, 100% complete, 100% verifiable, not misleading, not obsolete. But there's no law stating that that item has to be reported in the first place. If it gets deleted from the credit profile, no laws are ever being broken there. So, also, if somebody has, say, a used car that they bought from a mom and pop shop down the road, that doesn't necessarily mean that that shop has a contract with the credit bureaus to report. So you may have a car loan with buy here, pay here place. They probably will not report that vehicle to the credit bureaus. They may have a negative contract where they would only report you if you did something wrong. Currently, FTC studies show that 80% of credit reports have some sort of detrimental error. Errors can be anything from a dash in the date of origination to like identity theft. Now, typical errors are about 15 to 20 points off of the credit score. Identity theft, people think, is a huge issue because you're always hearing about it. Well, identity theft sells subscriptions to monitoring service. It's a very small percentage of the issues that we see when we're looking at credit reports. The bigger issue is identity fraud. So let me differentiate those two real quick. Identity theft is where somebody maliciously takes your personal information for their own personal gain. Identity fraud is nothing more than misinformation on the credit report. This happens on the creditor level. It happens on the credit bureau level as well. On the creditor level, easiest example I can give you is when somebody names their child after themselves and you've got a junior and senior. Most collection companies have two things. They have name and address. Well, who's lived at that name and address? Junior and senior. And because of that, oftentimes those accounts get merged and you'll see both information on both credit reports. Another example is if you have common first and last names in a larger metropolitan area. That's almost guaranteeing to have issues on a credit report. Your name's John Smith and you live in a larger city, chances are there's other John Smiths out there, and because of that, you're going to get your information added to theirs, and you're going to get their information on yours as well. Now, why does this happen? Yes, some of it's mistakes. Some of it's the collection companies not caring whose debt this really is. Collection companies know that if they have the same debt on multiple credit reports, they have a higher likelihood of collecting. Now, most people, when I say that, they're like, well, wait a minute, isn't that illegal? And yes, technically speaking, that is illegal to put the same collection on multiple credit reports. However, if you look at the collection companies, they typically don't care because what's the likelihood of some negative action being brought against them? If you look at the collection side of things, in order to purchase a home, you have to be qualified for the mortgage. If you're not qualified due to this one collection, you're not out anything. You can't sue somebody for a missed opportunity. you would have to first get qualified for the mortgage, get the mortgage at a higher interest rate, be paying on that mortgage with the higher interest rate, and then come back and be able to prove it's all because of this one negative item. So it's very difficult to prove that type of error and recoup or sue a collection company for that. So that's why they really don't have any fear about putting the same collection on multiple credit reports. Now, that's all on the creditor side. On the credit bureau side, their own policies can cause identity fraud to happen. It's the credit bureau's policy that if the first 5 letters of an individual's first name and 7 of the 9 social security numbers match up, those accounts could get merged. So an example would be like if you had Jose Gonzalez out in California and you have Joseph Smith out in New York, and they have 7 of the 9 social security numbers match up, they can put those 2 accounts together. That's where the also known as section on the credit report becomes so important. And just to kind of give you an example, it doesn't have to be like 7 consecutive numbers. It's not like the first 7 or last 7. It could be 1, 2, skip the 3, 4, 5, 6, skip the 7, 8, 9. So, I mean, it just kind of shows how that can happen. But those are all kind of typical errors on credit reports. The next slide I'd like to ask you all, have you ever thought about why are there 3 scores on a tri-merge credit report and why are they so different? It's a 2-part answer. The first part is that you've got different information at all the credit bureaus. The second part of this is that that information is then calculated by different scoring algorithms. So first, how do the bureaus get their information? You need to remember that the credit bureaus are nothing more than a large data warehouse. They provide the information for your credit report. That's it. That's where they start and stop. They get this information by selling contracts. They have a positive contract and a negative contract. Your positive contract is going to be on your larger ticket items, your mortgage, your automobile, your credit cards. Everything that reports every single month is a positive contract. It helps build your positive credit. Now, the other thing you got to remember is that these credit reports are not for consumers. They are for lenders. So when you take a look at that, those positive contracts, why do you think a 30-day late is so damaging? It's basically like shooting a flare up in the air so the lenders can go, hey, wait a minute, this person's been paying on time all this time. Now suddenly they're going late. I don't know what's going to happen here. Let's step back for a little bit and see which direction they go. That's where the lates are coming into play and why they're so damaging when you first get hit with a 30-day late on the positive contracts. Now, negative contracts are much, much cheaper than positive contracts because there's much less work involved. Negative contracts are the single one-time reporting items, such as collections, settlements, judgments, charge-offs, all those single one-time items. Now, they're just as damaging as a brand new 30-day late, typically a 100, 110-point drop with a brand new collection when it's your first collection. Now, the example I typically give people is their cell phone. You go late on your cell phone, it doesn't report to the credit bureaus right off. They simply go, hey, we got our own carrot and stick, just service off. They turn your service off, you go, oh, hey, I need to pay my bill, you pay your bill. You still don't have a problem with the credit bureaus. It's not until you go 60, 90 days and they go, hey, I don't know if I'm ever seeing this person again. Now you're going into collections, and that's when the negative contract will negatively impact your credit score. So that's how the credit bureaus are getting their information. Now let's talk about the scoring models. FICO, what's their role in this whole mess? Well, FICO stands for Fair Isaac Corporation. They've been around since the late 50s, early 60s. It was a mathematician and statistician from MIT that got together. Now, they were not there to really change the world. They wanted just to get away from the system of, hey, this guy's my buddy, you should give him a loan. They wanted to have something where people were judged on their own merit. Now, currently FICO has 55 different algorithms, which they sell. What you really need to know is that only 3 of them are used for the mortgage industry, and that's Beacon 5.0, Fair Isaac version 2, and Classic 04. So everybody's getting their FICO score now if they have a Discover card. Well, that's not your mortgage FICO score. Also, if you go and get an automobile and they pull your FICO score, that is still not your mortgage FICO score. Now, each of these algorithms weighs things slightly differently. For the mortgage industry, I can confidently tell you that Beacon 5.0 is harsher on 30-day lates than what Fair Isaac version 2 or Classic 04 is. If we're looking at collections, then that role reverses. Now it's Classic 04 is harshest, and then Fair Isaac version 2, and then Beacon 5.0. So it just kind of illustrates how they weigh the information differently. Now, currently we say there's 4 industries that calculate credit. Mike, let's throw a poll up there real quick to have people kind of touch base on. Where can you find an accurate mortgage credit score? Do me a favor and just take a moment, read through those, and pick one where you think that might be coming from.
Yeah, everybody can use their mouse to click on the right one that you think is correct. We'll give it another 30 seconds, though, see what everybody thinks. Okay, wrapping up in about 10 seconds. Okay, poll is closed.
All right, Experian.com or freecreditreport.com. TransUnion's second, it looks like. There's my FICO highest there.
Yeah,
well, let's talk about this real quick. There we go, myfico.com. So myFICO is a great resource. Unfortunately, they are using FICO 9, which was just released last June. They're not using any of the mortgage algorithms. In fact, you cannot get an accurate mortgage score online. Only a mortgage professional can provide you with an accurate mortgage score. I know, Bean, right? Trick question. But I kind of want to address where that's coming from. Now, any number of people can come up with their own scoring model. FICO is not allowed to have a monopoly. So freecreditreport.com was on there. They were the first ones to really kind of pioneer into that section, and they're saying, hey, you know what? Here's your credit score. What they're not telling you is here's your absolutely worthless credit score that nobody can use for anything, and they just made it up in the back. So we say there's 4 industries that calculate credit. That's going to be the mortgage industry that has their own set of algorithms, the automobile industry, the credit cards and insurance also have their own set of algorithms, and then last but not least, online. So none of the online websites will have accurate mortgage scores. That's the important thing to take away from this. Now, what you want to do is look at your trend when you're looking at your online scores. If you're trending up, that's a good thing. If you're trending down, you're going to be trending down on your mortgage scores as well. So what you really want to learn from me today is this, how your score is composed. 35% of your score is coming from payment history, 30% from amounts owed, 15% from length of credit history, 10% from types of credit, and 10% from new credit. But what does really all that mean? Let's go into each of these. So first one is going to be payment history. Mike, you want to advance that for me? So 35% payment history, what is that? Well, that's where a lot of people think their scores start and stop, meaning I pay my bills on time, I'm good to go. Well, that's only this section. This is where all the negative information lives. This is where all the positive information lives. So if you're looking at a company that only works with removing the negative and derogatory information, they're only impacting this one section. You have to educate your clients on exactly how their score is composed and where everything's coming from. Next section is my favorite one to teach. It's the 30% for amounts owed. This is where all the credit cards live. This is a huge section. If you do not have a revolving account, you are not participating in this portion of your score, meaning you're missing 30% of your credit score. You have to have some sort of revolving account. Now, the way this works is, remember how I said those algorithms can't be wealth biased? That's the same in this section, meaning if you have a $50,000 line of credit and you have a $300 secured card, those start out as being even. So if you've got one account, it's worth 30% of your score. If you've got 2, each one's worth 15%. If you've got 3, each one's worth 10%. All the way if you had 30 revolving accounts, each one's worth 1%. Then it's the debt utilization, which is nothing more than the more you use, the more you lose. And it breaks down from 0 to 30% debt utilization, which is simply your balance divided by your credit limit. You're going to lose 0 to 10% of your available points. If it's from 30 to 50% debt utilization, now you're losing 10 to 25% of your available points. Go from 50 to 90, though, now you're losing 25 to 90% of your available points. You're drastically impacting your credit score when you're spending over that 50%. So there's 2 ways to improve the score in this section without spending money, believe it or not. First one is asking for an increase in your credit limit. It's a great tool to kind of keep in mind. Typically when I recommend this to any of our clients, I'm looking for 3 months of 3 times the minimum, meaning if their minimum payment of $25 is what they've got, I want to see 3 months of $75 payments. That way it looks like they can handle a higher debt load. Now, to understand how that impacts the score is if you've got a $500 balance on a $1,000 credit card, that means that you're at 50% debt utilization. If you get that increase, credit limit increased to $2,000, that same $500 balance is now only 25% of the available credit line. You just improved your credit score. The next way to improve your score in this section without spending money is through balance transfers. balance transfers are a great tool that people often overlook. The example I have is a gentleman I worked with about two and a half years ago. He had a $12,000 line of credit with a $3,000 balance. That one account looked great. Problem was, I'm talking to him in March, and he had fallen into the trap over the holidays of open a new account, get 10% off. Open a new account, get 0 months or 6 months 0 interest. So he had opened 4 new store cards. Now these store cards, basically the purchases were maxing out the credit line. So he's paid these down to be about 86%, but total, these were only about $1,500. So he transferred all 4 of those over to the large card, and it opened all that cap space on the other 4 cards. So his score jumped through the roof next month. That was not somebody that needed help, with their debt utilization or with their really any negative information on their file. They just needed to know how to manage their debt differently. I was able to get his score fixed within literally about 45 minutes. So,
Chris, can I ask you a question real quick?
Yes, sir.
If I'm a realtor and I'm working with somebody out there that's, let's say they have limited credit and they're looking to improve their credit scores. We obviously got to be careful that we don't want to give people bad advice, but let's say somebody doesn't have any credit cards.
Okay.
Or what advice would you try to give that person?
There's numerous websites that have options of getting secured cards. The one I've recommended in the past on a regular basis is OpenSky.com. They have a $200 secured card, so it's not a huge investment, but it's still manageable more often than not. And that card, I know, does not do inquiries. So nobody has ever been declined for that card when they're starting to establish credit. I don't want somebody going out and trying to get an auto loan or get a installment loan or get a computer account installment loan or anything along those lines. It needs to be a revolving account so it opens this portion up to them. So.
Okay, so based on what you said, you want to make sure that they don't exercise all of their limit on that credit card. Is that correct?
Absolutely not. Typically what we're looking for them to do is use it once a month on something they are already spending money on, such as groceries or gas. In fact, we kind of call it the glove box credit card, meaning they keep it in the glove box so they're not tempted to use it while they're out, and then they're spending 1 tank of gas each month and then paying it all off except for, say, a $2 to $5 balance. That way it's always got a small balance on it and it's always reporting positively for them.
Okay,
So,
thank you.
Absolutely. Now, the next largest section on here is on the next slide, the length of credit history. This is a section that's often overlooked. This is an average of all of your open and active accounts. It maxes out at 25 years. So I don't know if you've ever had that neurotic person that you've worked with in the past where they're like, my score's an 804, why isn't it higher? Chances are it's because of this. They don't have a 25-year average. I tell those people, calm down, take a breath. You're going to get there. Just keep doing what you're doing. Now, a lot of people can use this to help improve their scores. There's actually 3 ways to lengthen credit history. First one's pretty easy to understand. It's close your newer accounts or deactivate your newer accounts. Sorry, I thought I was going to sneeze there. I apologize. The simple answer is that if you have a brand new credit card, that's taking away from your average. It's kind of weighing it down. I'll give you the example. If you've got a 5-year-old credit card, a 10-year-old credit card, and a 15-year-old credit card, if you pay the balance on your 5-year-old credit card down to 0, that's going to go inactive, and your average is going to go from 10 years up to 12.5 years. You just improved your credit score. Conversely, if you pay that 15-year-old card off or close that 15-year-old card off, you're going to negatively impact your average. It's going to drop down to 7.5 years, and you just hurt your score. So we're going to take a look and see what accounts they have available to them and see if it makes sense to pay off or close any accounts that somebody may have on their file. Now, there's another way to lengthen credit history that people kind of often overlook is authorized users. Authorized users are a great tool to help improve the score. Now, authorized users are never responsible for the debt. However, underwriters are getting tighter and tighter on this, and they don't want to see just some random person on somebody else's card. They have to have their own credit. But if there's a spouse that has a card that's like 15-year-old card that you can add your significant other to, that's going to help your significant other's length of credit history if their average is, say, only 2 or 3 years. So it's a great tool. I typically tell people with kids to add your kids to your credit cards as soon as possible. That way, when they turn 18, they have a higher credit limit, or excuse me, have a higher credit score than other 18-year-olds around them. It's a great tool also because when credit card companies look at your child, they're going to say, hey, wait a minute, somebody's been teaching them about credit, and they get classified as a different risk category. So they're more than likely going to be approved for a higher credit limit and lower interest rates right off the bat, just because of where their score is going to be compared to everybody else at that time frame. So authorized users are a great tool for that. Now, this section, types of credit, this is 10% of your score. This is basically the least interesting section if you ask me. It just wants to see a good mix. It wants to see the installment loan, the mortgage, the automobile, the revolving account, and the open and other. We're saying, hey, you know what? Typically, if you have a 1-to-1 ratio between revolving accounts and installment accounts, you're going to max out this section and get all 10% of your available points. Typically, people are going to have 3 types of installment loans for their lifetimes. They're going to have the mortgage, the auto, and the standard installment loan from the bank. If you have one revolving account matching up with each of those, you're great. You don't need 6, 10, 12 credit cards to help build your credit. 3 is enough. In fact, 1 is enough to open up that revolving account section to start out with. So that's another thing. I don't want somebody that's never managed credit cards before go out and get 3 credit cards all at one point in time, because it's much easier to fix 1 mistake than it is 3 mistakes if they max all their cards out or have issues with them. So next section on here, new credit. This is probably one of the most misunderstood sections out there. New credit is the only section where you're given all of your points up front and you can only lose them from there. And you lose them through 2 ways. You lose them through the new credit penalty and you lose them through inquiries. So first with the new credit penalty, what is that and why is it there? The new credit penalty is there for nothing but to protect the lenders. They want to prevent you from getting your hands on a whole lot of credit at one point in time. So it's to prevent that person from getting a $5,000 installment account and then go blowing that money at the casino and then coming back and not be able to make their first 30-day payment. So this is roughly 42, 43 points is what you're going to get hit with when you open a new account, whether it be a credit card, an auto, a mortgage, a standard installment loan, it doesn't matter. As soon as you open a new account, you're going to get hit with this penalty. After 30 days, you get about half those points back. After 60 days, you get another quarter of those points back. After 90 days, you get the bulk of your remaining points back to you. Usually there's 2 to 5 stragglers up until the 120-day mark. So you get these points back relatively quickly. Now, that's the new credit penalty. The other side of this is reserved for inquiries. Inquiries hit you when it's a hard pull for 2 to 5 points on average. Now, a hard pull versus soft pull before we go any further. A hard pull is when it looks like you're trying to acquire more debt. A soft pull is when you're just looking into your information. So at times it can be a little misleading as far as where this is coming from. If you ask for an increase in your credit limit, that's you trying to acquire more debt. That will hit you for an inquiry. If it's where the bank or credit card company just issues you an increase in your credit, they've already looked into you. They've already done a soft pull. They know where you're at, and that's why they're offering you the increase in your credit limit. That is a soft pull. You will not be negatively impacted if you accept that. If you go online to check your credit score at any of the wonderful websites that offer it to you, that is going to be a soft pull. You're just looking for the information. But if you go online to, say, lendingtree.com, that looks as though you are trying to apply for a mortgage. Therefore, it will be a hard pull. If you just go to the bank and have your buddy pull the credit report because you want to see where you're at, it still is going to be a hard pull because it's coming from a financial institution. So that's the difference between a hard pull and soft pull. Ask yourself, does it look like I'm trying to acquire more debt? If it does, that's going to be a hard pull. Now, 2 to 5 points on average for the first 6 months for any inquiries. After that, it drops down to 1 to 2 points. It'll only do damage for the first year, but it may stay on the credit report for up to 2 years. Oftentimes, you don't even see them after 120 days, but it'll say up at the top or in the error codes on the credit report that you're being negatively impacted by inquiries, even though you can't necessarily see them. So now everybody's heard of shopping windows, and nobody really understands exactly what those are, where they're coming from. People think that they're, hey, so I can go out and find a mortgage lender that works for me. It's kind of partially true, but it's more for lenders. It's so if you have a 740 credit score after the first person pulls your credit report, each following lenders while you're in the shopping window should still have that 740. It's so that lender 1 doesn't have an advantage over lender 3, 4, or 5. They can still offer competitive products in that range. Because if you had a negative inquiry every time you pulled right off the bat, that means lender 1 is always going to look better than lender 2, 3, or 4 when they're shopping for a mortgage. Now, the truth of the matter is that with the shopping window, it only puts a temporary hold on the damage that the inquiries are going to do. Once the shopping window closes, all of those pulls will negatively impact the credit score. Now, when I'm going through, the next question is always, well, how long is the shopping window? It all depends on which algorithm you're looking at. For the mortgage industry, for the 3 algorithms we use, it's 15 days on one of the algorithms, 30 days on the other one, and 45 on the last one. So I always tell the lenders to go with the 45-day window, or excuse me, the 15-day shopping window, because they're never going to be wrong at that point in time. So that's how shopping windows work and how the inquiries negatively impact the score. Now, the fun thing with inquiries is, like on the auto side of things, they're a nightmare. As soon as you say yes, you want financing for the auto industry, they shop your information out to everybody in a 50 square mile radius. When you challenge them to provide proof they were given permission to pull credit in the first place, a lot of those companies don't have anything on file saying that you asked them to pull your credit. And those inquiries will come off, and that's another way we get scores improved. So while we're talking about it, let's talk about what can come off a credit report. If you could go to the next slide for me. The simple answer is everything. The long answer, collection of bankruptcy, BEAC items, charge-off, profit and loss, inquiries, tax liens, judgment, medical, divorce-related items, identity fraud, foreclosure, repossession, any and all lates. Now the question is really what's realistic and what's the time frame? Because a bankruptcy will come off the credit report after 10 years. A tax lien will come off the credit report after 10 years. A collection will come off after 7 years of the date of last activity. So what's realistic and what is the time frame should be the questions you're asking. Tax liens, a lot of people don't know that a tax lien will come off the credit report once you file one tax form with the with the IRS. It's tax form number 12777. If a payment arrangement has been made and you've made one payment, it's not allowed to be on a credit report anymore. So by filing that off, it will get released. Bankruptcies are kind of a fun one to touch on. First thing, when I'm working on a file, I always tell people, number one, I'm not here to help people commit fraud. I'm here to help people improve their credit scores. So even if I were to get the bankruptcy off, which, again, I've got a 10 to 20% chance of, it's never where they can say I've never had a bankruptcy. It's just there to help improve the score. But now the next question always is, well, how do you get items removed? Let's go to the next slide. We have a 4-step process for removing items. First thing we do is we challenge the company's reporting practices. The Fair Credit Reporting Act states everything must be 100% accurate, 100% complete, 100% verifiable, not misleading, and not obsolete in any way, shape, or form. So what we're first doing is looking at all those little surface areas. Is there a dash with a date of origination? Is there, does it say NA or unknown for the original creditor? And NA medical doesn't count for that. That's where they're trying to follow HIPAA laws and not put that you went to, say, a cardiologist. But is there X's in the payment history? All those examples are examples of incomplete information. That's grounds to get that item off. If they had the information, it would be on the credit report already. So chances are they don't have it and they're not going to be able to report that. Step 2 is where we really kind of separate ourselves from everybody else out there. We compose in-depth investigations into the debt itself. Example of this would be like on a medical collection. We want to look at every negative item like it's a trial. They're accusing you of doing this negative action. We're stepping in and saying, you know what, I'm not 100% sure my client did this negative action. I want to see some evidence. I want to see some witnesses. I want to see the smoking gun that proves my client did this negative action. So we're looking at asking them for information like, when were you admitted? When were you released? Who's the insurance carrier? How much did they pay in towards the debt? What was the balance after the insurance company paid? Who was the doctor that performed the procedure? If they're unable to respond or verify those items, then it's going to come off the credit report. When we're doing this, very similar to a dispute, they only have 30 days to respond. If they're unable to respond within 30 days, then the item's going to come off. Very similar to a dispute. Now, in my eyes, the dispute is when somebody goes online, clicks a button, says this account's not mine. I'll be very honest with you and tell you that does work sometimes, but it's not nearly as impactful as what we do. But at the same token, our process, because we're challenging the credit bureaus, dispute verbiage will still go on the credit report, and it's important to know that because what happens when you dispute an item, it basically pulls that item out of the calculation of the score. So oftentimes if you've got a semi-credit savvy borrower, they'll see that their score is improved just because of the disputes on the credit report. And they get trigger happy and say, okay, I'm ready to go now, when really they're not, because underwriters require all dispute verbiage to be removed from the credit report. Once that dispute verbiage comes off, that item goes right back to doing the most amount of damage it possibly can. So it's important to understand how that works together.
Chris, I have a quick question for you.
Yes, sir.
You mentioned the date of last activity. We had a question from the audience. So what if that date is wrong or is missing? Have you had situations where that's happened?
Both, yes. So if it's wrong, that's grounds to get it off first and foremost. And if it's missing, that's also grounds to get it off. Usually, there's been a lot of class action lawsuits lately where people have tried to create new dates of last activity or omit them so they can keep that debt on the credit report. So usually it's either threatening them with the lawsuit, class action lawsuit, or asking the creditor to provide that information when they're unable to. Typically you can convince them to get it off. If it's where you got to be careful when you call the creditor, though, because you don't want to create the date of last activity. If you discuss a payment plan, if you discuss the option of paying, or if you admit that that debt is yours, that's going to create a new date of last activity in and of itself. So the first thing usually when we're talking to people, and if they're calling creditors, first thing you want to say is that I am neither confirming or denying this debt at this time. That way they can't just take that as you're updating this date of last activity. So did that answer your question, or did you want me to elaborate?
Yeah, it absolutely did, and I think you bring up a good point that you're probably going to get to this later as well. Is, you know, obviously there's going to be consumers out there that want to address their own credit situations their own way. Yep. They have options of engaging attorneys. They have options of engaging a professional organization like yours, and obviously there's a number of companies that do this type of thing, some of them well, some of them not so well. Obviously you always want to deal with, you know, a reputable credit repair company, just like you would want to deal with a reputable lender. Right. Any advice on that topic for the audience?
The first thing, if you're looking for a credit restoration service, is remembering that a credit restoration service is only going to be really impacting that 35% for negative payment history. If they're not educating the borrower on where everything else is coming from on their credit score, they're doing your clients a huge disservice. Your borrower really needs to understand exactly how much of an impact they can have on their own credit score. Because without that buy-in, it doesn't matter how much negative information you get off. If they're not building positive credit at the same time, they're still not going to be able to get qualified. That's what it boils down to, really. So,
okay, thank you.
Real quick, the last way we get items removed, we are tenacious. We don't go away after just 1 month. We continue to work on the file until the client tells us to stop. The reason this is important is because most debt collection companies collect only about 20% of their debts. So $150 medical collection realistically is only worth $30 to them. So if they take on our investigations and answer all the questions the first month, great. Wonderful. You verified those questions, but I'm still not 100% sure. I'd like a little more information. So if they took 2 to 3 hours the first month to answer everything we were looking for, now they've invested, if somebody's making $10, $15 an hour there, they invested $30 to $45 in that debt that first month. That's only worth about $30. So what happens next month when you come back and ask for even more information? At some point, they go, you know what, this is not worth my time or money. They don't report back, and at that point, the item comes off the credit report. So now, next slide, if you would, Mike. How can you, as a realtor, help? First thing I want to address is be patient. Most credit issues are not resolved overnight. They weren't created overnight. It's where it takes time. Even our process, and I'm going to tell you it's top in the industry, is just because I work for this company, but at the same token, we average 15 to 20 points per month. So if somebody's 100 points out, that means it's going to be on the fast side 5 months to get things cleaned up. Now, have I had a file jump 100 points in a single month? Absolutely. Have I had a file jump only 1 or 2 points in a single month? Yes. So it all depends on kind of what's on their credit report. And you got to look at the credit report like each one's a thumbprint. No one's credit report is exactly identical. That also means that if they're not there yet, they should not be under contract for a home in any way, shape, or form, because they're either going to lose their down payment or it's not going to be a positive outcome. They need to make sure that they have a approval letter and they're ready to move forward, and that their score is where it needs to be before anything along those lines come. Have your team know your strengths. I'd love to say yes, absolutely, come over and use me. If you're not using me, use somebody, engage somebody, ask them lots and lots of questions. Just the little tidbits of information I gave you today, I'm willing to bet you know 95% or more than 95% of the population when it comes to credit, just by the simple points that I covered today. And really, that's just kind of the tip of the iceberg when you're working with a service. They should be able to provide you with a lot more information as far as exactly where everything's coming from. So, perfect. What questions are out there? Are there any others popping up, Mike?
Not yet, but I'll give everybody a minute to type in any questions they may have. You know, I do want to add that, you know, as a nationwide lender, American Equity pulls thousands of credit reports every month to qualify borrowers to purchase home or potentially to refinance. So this subject really is near and dear to our heart. Just like I know with many realtors, you're always wanting to make sure that you have somebody pre-qualified before you put them in your car and start showing homes. You know, it's very important that as a lender or any lender that you work with, that they have a follow-up campaign to follow up with borrowers, because today's credit problems are going to be tomorrow's home buyers. I think that the majority of people want to ultimately own their home. They want to realize the American dream, and so you know, we have a mission to try and make sure that we get people eligible to purchase. So you know, your mortgage planner or your lender, your loan officer, whomever you work with, make sure they have a solid follow-up program, because when that borrower does qualify, whether it's 90 days, 6 months, or a year down the road, you know, we've had a lot of people that come back and we pull their credit again, and now they're ready to buy. So we get them back to that realtor that sends them to us so that we can make sure that they're out there purchasing their home. So a question I just saw, how much does it cost to get credit repaired? Great question.
It all depends on what company you're using. For us, it's going to vary depending on state. So our general billing is normally it's $129 to enroll with us. We discount that down to $29 for our preferred vendors that we work with, $29 to enroll, and then $99 a month for as long as they're with our program. Now, the follow-up question always is, well, what's the incentive for you guys to get them back to us as quickly as possible? And to answer that question is, I don't make a ton of money by keeping somebody in our program. I get money off of referrals, and if I'm not referring people back, I stop getting referrals. So I have to get those people back into closed loans in order to continue to get referrals, plain and simple. So now every company has their own different pricing structure. Most states, I will tell you, everything must be billed in arrears, meaning after you do the work. So if somebody's charging clients $500 up front, they are actually working illegally. There are 4 states that are very strict, and you can't charge anything until after the program has been in the process for 90 days. That's going to be Colorado, Minnesota, Wisconsin, and Maryland. So we're very familiar with state guidelines, and I'll also tell you there's 2 states we don't work in, and that's going to be Oregon and Kansas. And the reason we don't work in those states is because their laws state that you can only charge $50 total in order to work on somebody's file. And unfortunately, with the amount of work and time we put into that, it's not worth it for us. So we don't do business in those 2 states.
I understand. I've got a couple more questions coming across, but before I get to those questions, I want to just give everybody a heads up about next month's event. Jeff Lobb has done a couple presentations for us, and next month's event, Jeff will be talking about the top 25 apps for real estate agents. In today's mobile environment, I think as everybody's aware, there are hundreds of thousands of apps in app stores. So what are the real ones that real estate professionals need to know how do you need to use them, which ones will make you money, and which ones will make you more productive, because it's not just about being online, it's about making sure you're getting business from it. This will be a very fast-paced session. Keep an eye out for this event coming out to you, and I know it'll be a great and exciting event. Chris, our next question, if the date of last activity isn't on the credit report and or is incorrect, is that grounds for dispute with the reporting agency, or must that dispute be filed with the original creditor?
You'll want to file it with the reporting agency, the credit bureaus. And you always want to work through the credit bureaus is what I always tell people. If you do it yourself, try and go through the creditor. Creditors, again, they don't care. They have zero incentive to do anything for you. Even if you've paid them, they still don't care. So working with the credit bureaus or through the credit bureaus is definitely the way to go on that. Okay,
now if, let's say, you're a person that has multiple issues on their credit report, maybe not just something that has a date of last activity. You know, as a credit repair company, are you going to work on all those things at one time to try and clear them up as quickly as you can, or or one at a time? Share a little bit on that.
Good question. If you go after every negative item on the credit report at one time, it gets flagged as frivolous, and it basically stops them from working on your file whatsoever. So realistically, you can only go after about 25 to 35% of the negative items per month. So if you can contest it with all three credit bureaus, each negative item, but not all of your negative items at one time. Does that make sense?
Absolutely.
Okay, good.
Good. Any other questions we have out there? Okay, Chris, I can't thank you enough for educating all of us. Very informational. Thank you very much. For everybody out there listening, you're going to receive a survey shortly after this event. We really would appreciate your feedback and any suggestions you have for future events. We will then send out a link to our YouTube videos. This particular session is being recorded, so if you missed it, or if you want your peers or your office to see this video webinar presentation, you can play it back by just accessing the site. Any feedback you have, please share it with us. We appreciate your time today and for everybody showing up. So with that, thank you for attending AEM Achieve. We hope to see you at next month's event with Jeff Lott. Have a great day.
Thank you for having me, Mike.
Thank you, Chris. Bye-bye.